Give us a sense. Is that clickbait, or do you think there's some real danger of all this, I'm going to call it enthusiasm, you call it natural stupidity, really impacting the market?
I think it's not just clickbait. You know, there's a few interesting things. I mean, that headline actually comes from a quote that I use, a great quote from Amos Tversky, one of the founders of behavioral economics. He said, and this was all the way back, he died in 1996, remember, so this was a long time ago. And even back then he was saying, my colleagues, they study artificial intelligence. Me, I study natural stupidity. And that was the beginnings of the behavioral economics movement, and it's got some interesting things to say, I think, about AI today.
Yeah, I read your article. It was a very interesting article. I really encourage everybody to read it. We're going to try to summarize and distill what you had in there right now. One of the things in that article was a chart showing the AI winners and the AI losers. Alphabet was one of the winners. NVIDIA is one of the winners. Chegg is one of the losers, obviously impacted by the thought that AI could disrupt its business. But one question I want to ask you, how do we know that investors are being stupid? Isn't there just a big ramp up towards AI? Isn't there a big opportunity? Our colleague Bob Pisani often says the stock market is actually a discounting mechanism looking at future revenues. Aren't there just big revenues when it comes to AI in the future?
Exactly. So that's the first thing we can take from behavioral economics. You know, traditional models of asset pricing, they operate exactly as you say. They would say, look, we look at these, you know, these huge gyrations that have gone on in the stock market recently. You just mentioned a few of them, whether it's the suppliers of the things that go into the hardware, NVIDIA, whether it's companies that have said that they're adopting AI, like, you know, Microsoft. They've done incredibly well, and their stock prices has risen a lot. Or companies where their stock prices crash because, you know, they're deemed to have made a mistake by not adopting. And traditional asset pricing models would say, well, that's just discounting future revenues absolutely accurately. But of course, behavioral economics says, no, people aren't like that. You know, there are bubbles, there's fear of missing out and all that kind of stuff. And that's actually what's driving this. It's all irrational. These profits will never emerge.
Felix, I'm really enjoying this article, by the way. Again, I encourage everybody to read it. It's great stuff in here. One thing I want to ask you about, it's a very specific question. I want to look at a company called C3 AI. So it shares up more than 100% year to date. A lot of enthusiasm. AI is in the name, but they also power AI. On the flip side of that, its short interest is above 30%. So isn't that, you know, I guess not natural stupidity? I mean, there's some people who really believe in the stock, up 127% so far this year. But on the other side, people are betting against it at a very high level.
Sure. That's absolutely right. You know, the thing about bubbles is we don't know exactly when markets are in bubbles and so on. It's just a word of caution, that this part coming from behavioral economics, it's a word of caution saying, listen, we all know that in reality, markets aren't completely efficient. They do get bound up in these things. And if we remember Charles Kindleberger, the great Charles Kindleberger, author of probably the most famous book about speculative bubbles, Manias, Panics, and Crashes, he points out in his schema, looking back over hundreds of years of financial history, that all bubbles start with what he calls displacement, some real innovation, some real change in real world technologies that's always enough to change the narrative, change people's expectations. And it's from that people can start extrapolating in unreasonable ways. So that's all we should be aware of. No one's saying that this is not a revolutionary technology. It clearly is. But we've got to be aware of the market getting wound up in its own exuberance.